Key inflation data out of China showed consumer prices fell 0.3% in July year over year. Now, that's the first time in more than 2 years that China's consumer prices slipped into deflation. Let's bring in Yahoo Finance's Blikre to discuss this more. Hey, Jared.
Well, let's take a look at this graph here. This goes back a few years. Purple line is consumer prices, and you can see they just barely dipped into negative territory. That is a huge problem for the central bank over there. You can agree with it or not, but the biggest fear that central banks have is a deflationary spiral, and this is the first step. Actually, producer prices, I should say, in the cyan line, those dipped into negative territory in the fourth quarter of last year, and those can be seen as a bellwether of what's to come. But the bottom line is China has been trying to goose their reopening, and they have been failures so far. They've tried to stimulate various sectors like the property sector on its own because they don't want a wholesale inflation to eventually come and grip the country. But as you can see, they really don't have to worry about inflation too much right now. But let me show you why that could be important in the future. We need to take a look at the Chinese currency, the US dollar versus the Chinese yuan. This is a year-to-date chart. And the higher the line, the stronger the U.S. dollar is, and the weaker the Chinese currency is. So when it goes up, that means the Chinese currency is weakening. Right now, we just broke out of a consolidation, and this means that the Chinese yuan is weakening higher. And this is important because a key level is just above. We can see we hit this high last year. If we go above that high, who's to say where it would stop? Because let's take a look at a max chart. In fact, we'd have to go all the way back to before the global financial crisis to find any period of time in which we had some price history here. And in fact, there's very little overhead resistance. So the Chinese authorities are trying to stimulate the economy. Their last relief valve is probably a devaluing of the yuan. They did that in 2015. They don't want to do that again. It comes with all kinds of political costs, but their backs are up against a wall here. Let me show you what's been happening with the NASDAQ Golden Dragon Index components today. This is a China-centric market, and you can see kind of a mixed board. Over the last 5 days, we've seen some significant weakening here, but over the last month, and in fact year to date, we've seen largely positive price action here. So stocks being forward-looking, you could say a number of things about them, but the stock market there not under as much pressure, or not showing as much pressure as you might think, with the country outright going into deflation. Going forward, I'm going to be honed in laser-like on the authorities there, the PBOC, whatever measures they come out with. As I said, the final backstop is probably a wholesale devaluing of the currency, which they want to stay away from, but that is a possibility at this point, Rochelle.
Indeed, and clearly consumers not willing to spend. And China, historically a nation of savers, still not motivated to spend at the moment. We know we'll be keeping an eye on that. Thanks so much, Jared.